After hitting record lows last summer, Canada's mortgage brokers are warning that fixed rate mortgages are starting to climb back up higher. Here's everything you need to know about the rising mortgage rates and the steps you should take if you want to lock in your savings right now. Homebuyers and homeowners rushed to join the party when the COVID-19 crisis took hold of Canada, producing some of the cheapest mortgage rates the country has ever seen. To recap the Canadian housing market in 2020, we had dirt cheap interest rates, fewer home listings, and an insatiable demand, fueling sales and multiple bidding wars. Over 550,000 homes exchanged owners in 2020. So far in 2021, this trend has continued. However, there is something starting to take shape. 5-year fixed mortgage rates are starting to climb back up for the first time ever since the pandemic took hold. If you want to take advantage and lock in these historic ultra-low mortgage rates, you'll have to take immediate actions, steps which I'll cover in this video. Some of Canada's top economists have issued warnings about real estate prices in the country's hottest housing markets. Some economists are calling out the housing market and saying that we are in one of the biggest bubbles of all time. And I tend to agree that we are in the biggest bubbles of all time. And in my opinion, that warning should have come out much sooner. Just as the housing market is gearing up for the traditionally busy spring season, lenders across the country are considering increasing their fixed rate mortgages by 10 to 20 basis points. If you're looking to buy a home right now, you should consider long duration mortgages with fixed term mortgages rather than variable rates. Those fixed rates will lock in that mortgage payment even as the rates start to rise. It's not a matter of if their interest rates will rise, it's a matter of when will interest rates rise. In order to repay these hefty mortgages with your average income or your highly taxed income, very high interest rates will almost make it impossible to keep up, especially for those that have multiple properties, whether in Canada or elsewhere. Let's look at the math behind rate increases. Let's say you're buying a $500,000 home with a 10% down and a 25-year mortgage. If the rate on your mortgage goes from 1.39% to 1.54%, which is an increase of 15 basis points, that will cause your monthly mortgage payment to go up by an average of $32, which translates into an extra $400 per year in mortgage payments. Now that $32 may not seem like much, but remember, this is a $460,000 mortgage on a $500,000 home and an increase of only 15 basis points. But as these rates start creeping higher, especially in quick succession, that could easily cause your monthly mortgage to balloon out of hand very quickly, especially when you consider the large mortgages people have to carry just to compete in Canada's hottest housing markets. Variable mortgages tend to move up or down, following movements in the Bank of Canada's trend-setting policy rate, while fixed mortgage rates are generally more influenced by the conditions in the bond market, which affects the lender's own borrowing costs. Encouraging signs for both the US and Canadian economies are stoking concerns about rising inflation rates and pushing up bond yields, which makes it more expensive for lenders to borrow. Lenders in turn then adjust what they charge to their own borrowers by increasing fixed mortgage rates. There is plenty of optimism going around about the economy as COVID-19 death counts fall, vaccination rates are going up, commodity prices are increasing, and on top of that, the US is preparing one of the largest stimulus packages. While Canada's big banks have yet to make major moves increasing the cost of borrowing, as bond yields continue to go up, it's just a matter of time. Once the Bank of Canada pulls back on its bond buying program, this will create additional upward pressure on bond yields, and as a result, cause an upward shift in fixed mortgage rates. However, for variable rate holders, the Bank of Canada is committed to holding its key interest rate at least until the economy is back on track. The expectation is that we will start to see rates rise earliest late 2022 or early 2023. So the question is, what should you do if you want to capitalize on these low interest rates before they inevitably start to rise? Step 1. Don't waste time. As home lending rates fell dramatically last year, borrowers with strong credit found that they could refinance a 5-year fixed rate for below 1.5%. That's the cheapest Canadians have ever seen. However, would-be buyers who don't act now run the risk of losing out on mortgage rates that are still very low compared to historic standards. Fixed rates have gone up about a quarter point so far, and that may cause some people to get nervous. But remember, you can still lock in rates that are just at or below the 2% mark, which is still an amazingly low threshold. For a first-time homebuyer, locking in one of these ultra-low rates can mean saving thousands of dollars over a fixed 5-year term. And if you're already a homeowner, you can refinance from a higher rate mortgage, potentially saving you thousands of dollars of interest over time. And you also get the benefit of having to lower your monthly mortgage payment. Step number 2, shop around, and then shop around some more. No matter what you're buying, whether it's a new car, insurance, furniture, or in this case, a mortgage, shop around online and compare rates from multiple lenders so you can find the lowest mortgage rate available to you. A low rate means a low monthly mortgage payment. On a fixed rate mortgage, your rate and monthly payment will not change over the course of the term, which is typically 5 years. By doing your research and speaking with multiple lenders, this will allow you to find the best available rate compared to just taking the first offer from your bank. Step 3, get pre-approved. Getting a mortgage pre-approval is a smart decision, particularly if you're a home buyer who wants to get a fixed rate mortgage. So what is a pre-approval? It's a formal letter from a lender that outlines how much money you can borrow and at what interest rate. In a very competitive real estate environment, where you and potentially 10 or 20 others are considering putting an offer on the same property, that seller is likely more inclined to go with a buyer who can show proof of a pre-approval, or in more recent sales, the one who is willing to overbid the most. So that's why it's important to understand and know your limits. Step number 4, keep closing costs on standby. Closing costs are fees that you'll pay to finalize your loan. Lenders generally have some flexibility on what they charge in closing costs, so you have some room to negotiate that down. Typical closing costs include home inspection fees, various taxes, title insurance, which protects the lender against any ownership disputes that may arise down the road, legal costs, and reimbursements of any utility charges the seller has already prepaid. Generally speaking, closing costs will come in at between 2 and 5% of your total loan amount. So that means if you're buying a $500,000 home, your closing costs may end up being roughly $10,000 to $25,000. When you're buying a home, this is why I recommend coming up with a budget, whether on paper or on Excel. That way you can outline the costs and visually see what your finances look like when all the dust settles. Now let's bring this all together. Canadian mortgage rates are increasing along with lenders' funding costs, as government bond yields are being driven up higher, in part because expectations of a brighter economic outlook. In some cases, fixed mortgage rates have climbed as high as 40 basis points since the start of 2021. Meanwhile, national home sales set another all-time record back in January of 2021. The national average selling price was up almost 23% year over year in January. When talking about cooling the housing market, the challenge is what sort of government intervention policy would be effective? Because often, when we're dealing with issues related to declining housing affordability, the government response may be to implement policies that make it more affordable for those buyers who can't enter the market. But what may actually end up happening is that you end up boosting demand, which then causes sustained growth in prices. This causes a vicious cycle. Make housing more affordable. This then increases demand, which causes a surge in pricing. We saw this happen when mortgage rates dramatically dropped. It opened up the housing market to even more buyers, causing the surge that we're seeing. Mortgage rates are rising across Canada. But my question to you is, will these rising rates tame our surging housing market? In theory, it should. But how long until we get to see the impact? I have promo codes in the description of this video for various discounts and sign-up bonuses. So please, make sure you take advantage of those offers as they help directly support the channel. If you have questions for me, feedback on this video, or maybe ideas on future content, let me know in the comments below. And while you're at it, make sure you hit that like and subscribe button. That's it for this video. Catch you guys in the next one.